Why gold's rally can survive this retracement. Hi everyone and welcome to Ainslie Insights, brought to you by ainslie.com.au, the home of Ainslie Bullion, Ainslie Crypto, Ainslie Wealth and the Gold and Silver Standard. Be sure to have a look. Today, welcome back, Bailey. Now, we've been discussing this quite a bit. There's been this bit of a pullback in gold. We've got people all over the place from one end who say just this is what happens, go with the flow. We've got other people who are panicking and going, oh no, that the top is in. There's a lot to unpack here. You're a great person to unpack it with. How are you going today, Bailey?
Very good. Volatility. The gold market is volatile. It's volatility. It's exciting. I love volatility. It's great. So I'm very excited to be here to talk about it.
Well, and you sort of hit the nail on the head with that first question, with that first point, volatility. People, and we've often said this in the past, they go to gold because they expect it to be more stable. That's often the argument for gold and silver. They go, well, maybe not so much silver. Silver is often volatile, but gold particularly, they go, well, I want that stability. And we've seen it not stable at the moment, but this is not uncommon. This is kind of what gold does when you zoom out a little bit. Yes, recently it's been quite stable leading up to this, but yeah, there's a bit to unpack here. So let's start off. If we talk about what has been driving this rally, some of the price predictions where, we sort of said gold reaching 4,400 an ounce in US dollars by 2026. We've got predictions of $5,000 an ounce not being unreasonable. Talk to us a little bit about what's been driving this rally.
Yeah, I think you just have to, as you said, zoom out, not just on the charts, but have a look at the world. I think gold is, yes, it's stable, but we are in very unstable times. Is quite frankly the only way to put this. So, in unstable times, people are going to flock to the stable asset, and that is going to change the stability of that asset. We've got. We're in the midst of a Trump presidency, so we've got geopolitical. Every day there is a new economic thing that he is doing, whether that's tariffs or wars or conflicts that are ceasefires, and then they're firing again the next day. So it's an environment. Gold still feels stable compared to somehow the environment that we are in, and I think what is starting to happen is. I've mentioned it before. I feel like the narrative might even be shifting a little bit on gold. It's not this narrow just a pure hedge against inflation. That's what it is at its core. But I think people are starting to see it as more of a barometer for everything in the macroeconomic sphere. So I think that's what we're seeing a little bit here. I think that's why we got such a big rally. And like every rally, once a little rally begins, you get all the institutional money just flocks to it. They jump on the hype. And then at the tail end of that, you get retail flow in as well. So we definitely saw that from a localized point of view. And we were speaking about it the other day. That doesn't last forever. So the ETF inflows have been crazy on gold, and naturally, if you get a big green candle like that, they flow straight back out. So that's the correction we've seen here.
And we've been making this point for a long time on Insights that if you looked at the rally, it was central banks driving it. They're really, it's quite funny actually from our perspective because we're sort of seeing people coming in and almost discovering gold for the first time. We've been banging this drum for a long time saying, hang on, the central banks were buying, particularly China, and they haven't stopped, by the way, but they were buying, and no one was interested. We didn't have lineups out the door. Now, that's interesting to me because this is the first time that we've seen any sort of additional contribution to that rally from retail institutions, like you said. But when you actually look at central banks, they were driving this for a long time. And I keep making the point, you follow what central banks do, not what they say. If they've been buying it up, they're concerned about this debt situation. I suspect that hasn't been resolved overnight. I mean, that's me being a bit sarcastic, but I think we're in exactly the same position we were in prior to this. And the price really, I mean, it's moved a lot, but it hasn't moved that much relative to the amount of debt and the issue that that was causing the central banks to be buying in the first place.
No, and I think that was sort of the point that I was making is when you do zoom out on the context of the world, there's a big green candle on gold, but it still is the stable asset, all things considered. Particularly when you think about risk, when you factor in that variable, right, which risk can be an opportunity cost type, a bit woo woo. What is risk? But when you factor in the risk of being in another asset, as markets expect the US dollar to continue to weaken. I'd argue that gold is still the stable option, because we still want our stable assets to go up. We want it stable in the upward direction, or else people wouldn't buy them. that stability is a myth in many ways. We don't want stability. We want volatility. We just want controlled volatility adjusted for risk. That's what we want. And I think with gold, yes, we've seen it, a big green candle, and now a slightly smaller but still big red candle. When you look at what it's actually done, where it started in this rally and where it's ended up, that's fairly stable. If you were looking at that over a 1 month period, it's actually done its job. Yes, depending on what day and minute of every hour you bought, that might adjust your opinion of it. But when you look at it holistically over the last however long, it's done its job. And as you pointed out, I don't think the situation with debt and inflation is going to get any better. So I think gold is going to continue to do its job. I think now that things have settled a little bit, we will get a bit of that stability back in the gold market. We will see it trend sideways for a little bit longer. But I think the long-term outlook on particularly gold is that it will continue to go up. And I think just this parabolic move that we've had may be starting to settle as retail is slowing down, the flows from the ETFs are going back out. I think we will see a little bit of that stability return, but as I pointed out, tomorrow is a new day and we do not know what is going to come out in the news. But gold will, no matter what comes out of the news, continue to do its job.
I love that explanation, because I think it really addresses some of those concerns that people have, where they go, well, hang on, is the end is here because we've had the spike and then the pullback. That's not the case. And I think when you make some of those historical comparisons, it is important to think a little bit more through what is actually happening this time in terms of supply and demand as well. Because yes, we've seen, that was kind of the point I was making before, we've seen relentless demand from central banks. They've just been buying it when there was no interest. So if all of a sudden you've now got front and center interest from other players in the market, this isn't a bubble in the usual sense of an asset that gets really a lot of speculative flows into it, because I'll use Tesla as an example, right? Like, I'm very pro Tesla, but using that as an example, all of a sudden everyone's very excited about it, then they lose excitement and that bubble sort of falls away. When you're talking about gold here, it's serving a very different purpose, and the fundamental structure hasn't changed, as you're pointing out. How do you think about that? Because you have access to some of this information when you're sort of dealing with it day to day. The supply side of this as well, because it hasn't just been about you can click a button and just get access to all this physical gold when the demand has picked up. There's real bottlenecks in the process. There's real things going on behind the scenes that people might not understand.
Yeah, absolutely. I think there's a little bit to unpack in there too, just about, with the Tesla example. And I think if you actually just scale it back, just really just take a step back from the moves and all the exchange traded gold. When you think of the fundamentals of why we buy precious metals and particularly gold, it comes down to, as you said, supply and demand. What is a share? It's intangible. Gold is a tangible asset, so it's always going to do its job. I think you've put it this way before. It's almost a mathematical certainty that it will continue to do its job. So in all of this noise, and what gets lost is the fundamentals of gold. We think of it in the same terms as these other assets, but there is only going to be as much gold as there is going to be. So that demand has absolutely skyrocketed. So of course the price is going to do what it did. Now, what we're seeing from, I think what you're sort of leading into is from sort of the more closer to home demand from the retail perspective is silver. We get this a lot. Because of the production, I suppose, the lengthy production and the time intensive production for silver and the weight of it. We don't tend to get it as much with gold. But what we are starting to see is suppliers are getting a little bit strained on that from a close to home level. It's certainly not in the same way that silver does, but for the first time in my experience with the gold market from a retail bullion perspective, is that it is getting a little bit more difficult out there for them. And I think that is representative of such a huge boost to demand from not just, the big central banks buying up the ton. That almost sounds mythical and otherworldly for the local human investor. But the local human investor is starting to feel that themselves because it is getting a little bit more difficult to get. Now, supply for gold is always easier, but we are starting to see little tickles of that through this run. And maybe now that will stabilize and the floodgates will open, that we've had that little bit of a pullback and the hype is starting to die down. But it didn't take that long for us to get to that point with gold. And we don't think of gold that way, particularly from the retail point of view. So I think a lot of people will have to look at that and realize that that fundamental fact about gold is that there's not that much of it.
Right.
Is that, as you've said, it's a mathematical certainty that when people want that, the price can go up. And as the world continues to head down the trajectory that it's heading down, the US dollar is going to get weaker. So people will want to buy gold because gold will get stronger, and then that will be this, as you said, a near bubble. But I think the context is different. I wouldn't call it a bubble. I just call it smart investing.
Yeah, and when we say the US dollar getting weaker, it's all currencies because they're all built on that same, very, very flimsy foundation at best. I just want to dig into one more point on that with the supply, and it's something that's often overlooked. It's not like there's a whole lot of mines that are being fired up every day. That's not how this works. When the price is high, they might start processes to create a new mine, but bringing them online, particularly in the modern regulatory environment, it takes a very long time. You've got there might be gold in the ground that realistically is not getting dug out of the ground because you've got to get through all of those regulatory hurdles. The cost is very high. So the supply is constrained. It's not like you can just click your fingers and all of a sudden we're digging a whole lot more out of the ground. It's a decision that's made by companies that takes a very long time to flow through. I think that's sort of an important addition to what you were saying there.
Yeah, absolutely. And I think, again, I mentioned before, it almost seems mythical. I mean, you have the idea of mines, but you think of how much money has to go into operating and running and producing a mine and pulling it out of the ground. I think I was reading the other day that there are, since 2018, the producers on average have only increased their supply for gold mines from 0.3% per year on average. That is definitely not matching the increased demand from particularly just the retail, which is what I see every day. So I think that's actually staggering when you think of just how little the mines have actually kept up with the demand, not just from the small players, from the big players. So I mean that brings into questions about the paper assets and all of that. But no, absolutely, it's a physical metal, and it's not getting pulled out of the ground quick enough.
And to wrap this up, we've had advice recently, recommendations from Morgan Stanley, talking, and I mean people take that with a grain of salt, but ranking gold as its top commodity preference, hedging against inflation and geopolitical risks. This is interesting because you're starting to get those big players saying that to the big end of town. Now, they are not easily spooked by that volatility. If they're taking a thematic approach, saying that, well, this is something that's a problem, they're identifying central banks are saying that this is something that's a problem, and they are following the money by doing it themselves. Is there a lesson to be learnt here for the retail investor who potentially is a little bit more skittish?
Yes. Do what the rich people do. They're smarter than me. They're probably smarter than you, and they're always going to have a lot more money than probably me. So if all of these smart, wealthy people cannot be, all of these governments, all of these companies, all of these institutions, they all see it. We all see it. There's a reason gold went up. So clearly this is all just a powder keg that is going to explode at some point. So do you want to have some gold in your back pocket, which is going to say, I don't want to use such explosive language, but that it will save you in a sort of a cataclysmic event. So, but that's just the long and the short of it. You need to have some of it. And I would argue that you need to have a lot more of it than probably has been recommended to you in the past, to put it bluntly. So,
yeah. And I mean, I've made that point recently. Got a little bit heated in my arguments around it, just saying, really, some of these advisors, they're not incentivized to encourage you to have gold and silver in your portfolio, and it is something that has performed very well this year. So, I'd
Well,
like to think
it
that.
doesn't quote unquote yield, right? So you'd
Yeah,
only
and
you want to be
I'd
buying.
like to think that
Yeah.
some of these advisors are sort of pulled to account on that to say, well, hang on, you didn't. Why yet again? Have you kept me out of this asset that would have protected me and actually performed really well? But don't get me started on that because I'll go down a rabbit hole. Look, really appreciate your insight into that, Bailey. It's something. Once again, we really value having your ability to sort of talk to us about that because you see it. You have additional insight that not everyone else has. So really value that and appreciate your time.
No worries. Thanks for having me again.
Thanks everyone for watching. We'll chat again soon.